Welcome. Hello and welcome to another Transition Accelerator webinar. It's my pleasure to be opening the session today. And I want to first start with our land acknowledgement. And as the Transition Accelerator is a virtual organization, as is Clean Prosperity, we have staff all across the country in many provinces, and we acknowledge the traditional territories of the Indigenous peoples on which we work and live. We recognize and respect the ongoing relationships that Indigenous peoples have to the land, and we commit to the ongoing process of reconciliation. And I want to acknowledge specifically that I am now on the traditional lands of the Arawak and Carib First Peoples, who were brutally slaughtered and driven from their homes by Europeans in the 17th century. On to our program. I want to thank Bentley, Allan, and Michael Bernstein for their outstanding research that comes at such a critical time in ensuring Canada's success for our economic future. I have had the pleasure of participating in the creation of both the Transition Accelerator and Clean Prosperity, being on the founding boards. And it has been truly remarkable to see both organizations grow in sophistication and influence over the years. And moreover, today, to see the highly effective research collaboration between both organizations. So as the world moves towards net zero, Canada has a generational opportunity to position itself for success in the 21st century. As we will be hearing today, we have the tools and assets to compete and lead in a sustainable global economy. We have a highly educated workforce, innovative companies, and abundance of natural resources and extensive infrastructure. So in order to meet these global initiatives head on, we really need to focus on how we position our country for success. It won't just happen on its own. It needs to be a very deliberate effort on our part. And we know that our trading partners, clearly the United States and the Inflation Reduction Act, which we're referring to today, but as well the equally ambitious European Green Deal Industrial Plan, are things that we need to be. So we need to focus on clean electricity production, providing investment and production tax credits, and accelerating regulatory processes to get projects built more quickly, and of course, supporting skills training for the sustainable industries and jobs of the future. So I don't want to get into all of the details. That's why we have Michael and Bentley here. And also what I do want to do before I depart the screen is welcome our moderator, Heather Scoffield. It's a pleasure for me to introduce Heather. She's a Senior Vice President of Strategy at the Business Council of Canada, where she crafts and pursues the strategic priorities of the Council in collaboration with her Council colleagues and members. Her focus is finding practical solutions to the major economic and growth challenges of our time: competitiveness, climate change, and a constantly changing workforce. Essentially, the three intersecting topics that we plan to cover today. So with that, thank you very much for joining us. Thanks again to Michael at Clean Prosperity and Bentley at the Transition Accelerator.
Hey, thank you very much, Bruce. And I will just briefly introduce our speakers, who, of course, you're all here for them. So I won't belabor that, but just briefly, Michael Bernstein is the Executive Director of Clean Prosperity, a Canadian nonprofit that works towards practical climate solutions to reduce emissions and grow the economy at the same time. He's an economist by training. Has advised political leaders across the spectrum, and been involved in business, management consulting, international development, and politics. And Bentley Allan, his co-author in the paper that they're going to discuss, is a research director at the Transition Accelerator, as well as an associate professor of political science at Johns Hopkins University. He's an award-winning scholar, and he's written on the dynamics of international order, science and politics, climate policy, and the political economy of decarbonization. He co-leads the project Canada's Future in a Net Zero World, which builds support for a green industrial strategy in Canada. And they are going to quickly take us through the highlights of their paper, which is all the buzz on Parliament Hill right now, luckily, because we are at a major point in making, the government's at a major point in making decisions, meeting with Joe Biden coming up and then followed by the federal budget. So it's very timely, and I will pass it over to them so we can understand where they're at.
Great, thank you so much for that kind introduction from Bruce and from Heather. It's really our pleasure to be here and to have such a great crowd. So Michael and I are just going to kick things off with a very quick overview. We want to get to discussion as soon as possible, so do get your questions ready. We wrote this report so that we could try to raise a level of discussion happening around how Canada could forge a strategic response to the Inflation Reduction Act. There was a lot of conversation about it, but we wanted to try to really crunch the numbers, do the math, and really think in a rigorous and systematic way about how the IRA is affecting Canadian competitiveness across sectors. We did this report, and this is just a working paper. We're going to have a larger public report come out over the course of the spring once we've had time to expand the analysis and deepen it somewhat. So your comments today will help inform that as well. So let's just start with a quick introduction to the Inflation Reduction Act itself. The important thing, I think, to understand about the Inflation Reduction Act is that it's a combination of tools. There are grants in it, and those captured the first public headlines. There's also an expansion of the loan guarantee for the Loan Program Office to bring it up to $400 billion of loaning authority. And there's also a series of tax credits, which have taken a long time, I think, for folks to really digest and understand truly what the impact of those tax credits are. And that's where we focus our analysis, but it's just part of the Inflation Reduction Act. And I also want to point out that these tax credits, and as well as the financial incentives as a whole that the Inflation Reduction Act represents, are only a small piece of what we're now calling the United States full industrial strategy in this space. The Department of Energy has also led strategic roadmaps in more than 20 sectors. Those roadmaps include targets and priority actions that are to be taken in collaboration by government and industry, working together, often through what we call in some of Transition Accelerator's work, independent intermediaries, whether they're the national labs, which are relatively independent from the Department of Energy, or through other vehicles. But there's a lot more happening than just the tax credits in an industrial policy, but they are certainly capturing the headlines, and for good reason. There are investment and production tax credits for renewables, CCUS, direct air capture, hydrogen, sustainable aviation fuels, regular biofuels, as well as advanced energy projects, and then 14 targeted manufacturing credits, which cover batteries, solar, and wind. And importantly here, the main tax credits in the Inflation Reduction Act are uncapped, which means that the $370 billion price tag that was often put on the Inflation Reduction Act in the days around its passing is far too low. There's a Credit Suisse estimate, which estimates $800 billion, and my own internal analysis, internal to my lab at Johns Hopkins, we think even that $800 billion is a vast understatement of the actual financial investment that the IRA is going to represent. What the IRA does, as we show in the report, is open up bankable gaps in a variety of sectors. So let's just focus in on this term that we use in the report. What does bankable here mean? Bankable really just means that a project has the right project economics in order to get financing. And then when they're looking at revenue sources from policy, some of these will be considered to be bankable, that is guaranteed, that is certain in a way, and some of them will be considered to be uncertain. And so what we do in the report is distinguish between bankable credits, like investment tax credits and production tax credits, which a firm knows that they can rely on over the course of their project because they're in legislation, and credits that are not bankable, that have some uncertainty around them, such as the carbon pricing markets, the revenues from carbon pricing markets in the Canadian system. Those are uncertain in two ways. They're uncertain first because we're not sure exactly what credit prices are going to be in those markets. So it's not certain what revenues firms are going to get. But also, of course, the whole framework itself has some policy uncertainty around it. We are perhaps only one election away from losing the Pan-Canadian climate framework, and therefore from those revenues disappearing. So what we wanted to do in the report is really take a careful look at the bankable gap from the perspective of the firm or an investor in each of these high priority sectors that we look at. And investment, I think, is a really important thing to look at, not just from a decarbonization standpoint, but also from an economic opportunity standpoint, because it's the early investments that will create the innovation ecosystems. If we have the first investments in DAC, then other firms and sources around that technology will cluster around the first deployments. The expertise and the IP will be developed out of those experiments. So early investments is really important if what we want to do is capture innovation over the course of a long transition. Turn it over to Michael.
Great, thanks Bentley, and great to be with all of you. Thanks for joining us. So let me talk a little bit about how Canada stacks up compared to what Bentley was outlining with the US approach. And I'd say Canada does have a number of promising policies. It's anchored on the carbon pricing system that Bentley just spoke about. And the key thing to understand about the pricing system as it relates to our analysis is that the industrial pricing system is different from the consumer carbon tax in that it has both carrots and sticks in it. Most people know about the sticks, which is that you have to pay a carbon price on a share of your emissions if you're an industrial firm. But the really key thing for our analysis is there's also these carrots, which is that if you reduce your emissions, a significant share of that emissions reductions, about 80% in today's, depending on which province you're in today's designs, is going to come back in the form of carbon credits that you can then sell to other firms who are looking to avoid paying the carbon price. And it's that potential carrot or those credits that end up being a big part of the analysis that you're going to see in the coming slides. So carbon pricing ends up being the anchor, but as Bentley said, there's a lot of uncertainty around it. And then in addition to pricing, you have a series of investment tax credits that have been announced by the federal government, most of them refundable, and that will provide an incentive or relief on the capital expenditures, whether that be on CCUS, on direct air capture, hydrogen, and a number of other clean technologies. And then, in addition to that, you have a number of large pools of funding that are application-based. So these are the Net Zero Accelerator Fund for $8 billion, the Canada Growth Fund, the Canada Infrastructure Bank, the Low Carbon Fuels Fund. There's a series of these funds, and when you add them up, they're actually a substantial amount of money. In fact, by my math, Canada is spending about as much as the US on a per capita basis if you include those funds, and if you assume the low end of the IRA analysis, to Bentley's point, it will probably be higher. But the way we're providing that funding ends up being unbankable, which is to say that the firm or an investor who's considering a project in Canada does not know if they will have access to those funds. And furthermore, will have to spend time and money, in some cases doing front-end design and engineering, even before they can figure out if they're going to access those funds. So the way I would describe it in short is if you compare the US and Canada, you have Canada with some policies that are essentially offering people, a coach seat on the plane, if you like, maybe a window seat that's a decent seat, and saying, look, if you get to the airport early and you wait in line, we might be able to upgrade you. And then you have the US sending everybody to first class right away. So when you have that choice, it doesn't turn out to be a very difficult decision on which option you're going to take. And we'll see that in the ensuing slides. So as we show you these, what we'll do now is we'll run through a series of the key clean technologies, starting with blue hydrogen. And as we do that, what you're going to see is the first set of technologies that we show you have a similarity to them insofar as these are technologies where we can use the carbon pricing system and those credits I spoke about to close much, or in some cases, all of the gap that exists with the US. And then a second series of technologies that Bentley will run through will not have carbon pricing be able to apply, or at least not in a significant way. And so we'll need other policy. So if we move to blue hydrogen, I'll just give you an example. What you see here is we're comparing an at-scale hydrogen facility, in this case, blue hydrogen, which would be fossil fuel based, and then separating the hydrogen and carbon molecules, and then capturing that carbon, which is what's often called blue hydrogen. And what we did here is we said, on an apples to apples basis, what would be the economic incentives available to that facility in the US, locating in Texas, versus if they were to locate in Canada, in Alberta in this case. And what you see on the top bars is that Canada does have some incentives that are meaningful. We have the hydrogen investment tax credit that was recently announced, although not finalized. And we have a CCUS investment tax credit as well. Now, both of those, if you add them together, and unfortunately, actually, the current rules don't even allow you to add them together, but even if you could, that would provide 9 cents per kilogram of hydrogen. So even though these are investment tax credits based on the capital expenditure, what we've done is, in order to compare them to the US, we put them in production tax credit equivalent terms, and essentially amortize them over the 10 years in which the Inflation Reduction Act production tax credits would apply. So think of those as providing 9 cents a kilogram, which is helpful to a firm producing over 500 million kilograms per year, but it pales in comparison to what the US is providing, which is that low, the bar at the bottom of the chart, which is $1. And when you're faced with this comparison, do you want 7 cents or perhaps 9 cents at the most versus $1? It's not a very difficult choice. I mean, a firm would be leaving almost $500 million per year on the table if they were to locate that facility in Alberta versus Texas. The good news, of course, or the perhaps I shouldn't say good news, but the potentially promising news that we'll talk more about later is that you do see that straight bar on the top too, and that's representing the potential revenue that this firm could generate from their carbon credits under the Alberta Industrial Pricing System. And by our math, that could be worth, in an optimistic scenario, as much as 96 cents. And that would close the entire gap, as you see on the chart. The challenge, of course, is that the firms can't count on that today, even though there is a possibility that those credits might be worth as much as $170 or close to it in 2030. They also might be worth $5 or $10. So there's a high degree of uncertainty, which is why you see the strike bars. Let's move to the next technology. And I'll show you 3 more slides, but I'm going to run through these a lot quicker because you're going to see a very similar story on these next few slides. So this next one is CCUS. The key difference here, and this, by the way, I should just point out, this is carbon capture on a cement plant, kind of using the Lehigh CCS plant as a bit of an inspiration, but looking at what an at-scale plant is. Most folks tend to think of CCUS as an oil and gas technology. This, of course, has a much broader range of applications. In this case, we're looking at cement, and you see a similar story. I mean, the US is ahead by not nearly as much. And actually, if Canada could find a way to provide that bankability on the carbon credits, we'd actually see a very significant bankable advantage in Canada. Let's move to the next one. So direct air capture, kind of in between hydrogen and CCUS, insofar as we actually do have a very generous investment tax credit in Canada, up to 60% of the capital expenditure. And here we're showing an at-scale plant like the carbon engineering plants that are currently being designed, or at least the initial one being built in Texas. So you see a pretty significant bar, $159 being provided for every ton of carbon being captured. And that's meaningful. It just pales in comparison to the very generous incentives you have in the US. And here there is an opportunity to use the tier credits again to help close much of that gap, even if it's not the whole thing. And then lastly, solar, similar story here. Of course, this would be most relevant in Alberta, where you actually have an open market for power procurement. And what you see here is there is a potential for a very meaningful bankable advantage in Alberta if we can find a way to make the credits bankable. So those are the first set of technologies. I'll pass it to Bentley from here.
In the second group are technologies where either the carbon pricing incentives would not be enough, even if we made them bankable, or where carbon pricing just does not apply. So green hydrogen is one of the first kind, where even when you put in the ITC, you're well short of what the production tax credit on hydrogen would provide. And I just see some conversation in the chat about the differences between production and investment tax credits. So I'll just take a second to explain that. Here, in the case of hydrogen, a production tax credit in the United States pays you per kilogram of hydrogen, whereas an ITC allows you to write off your capital costs. So even if you have a generous investment tax credit in a case of green hydrogen, it's not going to compete with a production tax credit, which pays you per kilogram of production, in part because operating costs and input costs are a major part of the production costs for green hydrogen. If capital is just not a major part of it, the capital for the electricity and for the electrolyzer, then that's not really, sorry, just for the electrolyzer, then that's not really a significant part of your overall cost. What we did here was we even allowed free permit applications to enter in from, sorry about that, free permit allocations to enter in from the Quebec cap and trade system. But this would only be able to be claimed if the facility already existed as a hydrogen facility. So actually many new facilities would not be able to claim this free permit allocations. And this is another key theme of our report, is that the complexity of having 11 different provincial and territorial carbon pricing systems makes actually understanding what the investment case is in each technology very complicated in and of itself. Another thing we heard when we started presenting these findings was, well, isn't our electricity so much cheaper that would make green hydrogen competitive? So we took a look at that too, and we compared Quebec's heavily subsidized commercial electricity rates to what you could get on a PPA, and that does deliver a major advantage, $1.43 per kilogram. That's a really big advantage. It just pales in comparison to the scope and scale of what the IRA production tax credit is putting on the table. Sustainable aviation fuel is a really complex case. If we did a true diagram of it, we have minuses and pluses. It's very complicated. But the key thing to take away here is that most of the revenue sources on the Canadian side and on the American side would mostly cancel out. So we can focus in, because there are credits in BC for sustainable aviation fuel that you can get through the low carbon fuel system, but California has those credits too. And it looks like soon the credit markets will have roughly the same allocations, and therefore the credit price will be probably about the same. There's also a Canadian fuels regulation, which would benefit sustainable aviation fuel in an opt-in option, but there's also what are called RINs in the United States, which are almost certainly going to pay higher credit prices than the Canadian fuels regulation. So we can focus here in on the PTC, but it's important to actually notice here, actually, this is only a 5-year PTC. So there's actually an opportunity here that we'll come back to in a minute. Battery manufacturing is just not touched by carbon pricing or by existing incentive systems at all. These are the advanced manufacturing tax credits, and this is the biggest and most powerful example of one. This is the tax credit from the IRA converted into Canadian dollars. And what that really shows you is, there's a big gap here. We can look at subsidies from the SIF as potentially offsetting some of that cost. And we basically calculated the per unit benefit of those subsidies that have been announced for some large battery factories in Canada. And you can see that it's offering only a couple dollars per kilowatt hour in comparison to $45.68 per kilowatt hour from the US Inflation Reduction Act. And also, those state grants were in for the Blue Oval facility in Tennessee that were done are actually about the same in terms of dollar per dollar value in Canada. So the subsidy value doesn't really impact the investment case. There's a similar story in cathode active material as those. I'm going to turn it back over to Michael so that we can get to the discussion as soon as possible here.
Great. So based on this analysis, we are suggesting 2 key actions from the federal government. The first is to make those striped bars that you saw in the first series of charts I showed you into solid bars. Make those, in other words, make the revenues that can be generated from carbon credits into bankable revenues. And the way to do that is through a contract for difference on the credits or the offset values. The idea here is the government offers off-the-shelf contracts to industrial facilities who are within these pricing systems and says, look, here's a price that we're willing to provide insurance on. Let's call it $150 in 2030, just as an example. We'll top you up to that price if the prevailing price in the marketplace is lower than $150. But the flip side is if the price is above $150, let's say $160, the company owes the government $10. And one of the benefits of this solution is that it's within the government's control, based on the way it designs these pricing systems, what the credit values essentially will be. So if credits are low, the government has some tools at its disposal to raise those prices by tightening the systems. And we believe that with a proper design, this is a tool that actually will not cost the government anything. And yet it will provide a strong signal and a powerful incentive across many of the key clean technologies. And I just want to note lastly that this is some folks will probably be familiar with the fact that there were mentions of contracts for difference in the fall economic statement through the Canada Growth Fund, but this is different from those because those contracts are very likely to be bespoke contracts for individual emitters. What we have in mind here is a signal that it could apply not only to existing facilities, but also potential new investments in Canada critically. And that's going to require a more off-the-shelf kind of program.
Our second recommendation is to advance production tax credits in key strategic areas. And these are areas where the work of the Transition Accelerator in collaboration with other organizations like the Energy Futures Lab and the Smart Prosperity Institute that we've looked at carefully and really have demonstrated that there's a clear Canadian opportunity in these sectors. These are areas where we can compete. We have both the economic foundations to do so and the technological expertise to do so. And they're also important for creating jobs and improving the livelihoods of communities across our country. So these are areas where advancing a production tax credit to stay level with the IRA would be justified. I think also it's worth closing and saying, just as a way of drilling down what I think the report was meant to do, is that we're not saying that a response to the IRA should just cut and paste the IRA into the Canadian context and call it a day. Rather, what we're advocating for is a strategic response. And just to use another analogy, when you're playing against a hockey team or a soccer team that sets up in a particular way and has certain strengths to it, and you're afraid that they're going to score a lot of goals, you don't set up with the exact same system in order to defend or to try to exploit the weaknesses. You set up with your own system, a different system, one that's calibrated to the moment at hand, that takes advantages of your own strengths, guards against your weaknesses, and seeks to exploit the gaps in the other folks' systems. That kind of strategic thinking is enabled by the kind of analysis that we've done in the paper, but it is not exhausted by the analysis that we have done in the paper. So one of the things that we say about those production tax credits is that they actually need to be part of a broader industrial policy of a strategic approach overall to figuring out where we're going to compete, how we're going to compete, and building the institutions of collaboration with industry, government, Indigenous communities, labor, and financial institutions across the country in order to do that in an effective way. And as Michael has already pointed out, it's clear that we don't really need to take on a big budget liability for these carbon contracts for difference. It's something that could be done quite simply and that would help to backstop the carbon pricing and provide some simplicity and some clarity to the investment picture in addition to something that's part of a broader industrial strategy. So we'll stop there and turn it back over to Heather. Thank you.
So thank you so much for that overview. And I see a lot of comments from people looking for, I guess, recordings and copies of the paper and so forth. And they are on the internet, and I believe will be distributed and posted after we're done here too. You'll be able to access everything. So for now, let's go to, I'll ask you a few questions, but I will also turn to questions from the audience so in a few minutes. So if you want to put your questions into the Q&A area, I will turn to those in a little while after I get through a few of my own. And so I was hoping you could just take a step back here and explain to me a bit about why are we so, obviously the United States is our biggest trading partner, but we are apparently a common market, so to speak. Why are we so focused on competing against the United States and attracting investment here as opposed to elsewhere in the world? Should we not also be concerned about Europe, for example, or Asia?
Go ahead. I'll add on.
Yeah, sure. I think that most of the siting decisions that we're concerned about are siting decisions that are taking directly between the United States and Canada. So if you're looking to think about Canadian critical minerals or creating value from Canadian biomass or from building on the innovation assets that Canadian firms have, it really makes a difference whether or not the next step of the value chain is located in Canada or the United States. So I would say overall, what the IRA does for Canada is create a systematic structural risk to the economy that we would be reduced to providing primary commodities for an American manufacturing and processing base. And this is something that every major review of the economy in Canada over the last 3 decades has warned about. That basically it's difficult for us to scale our own firms. It's difficult for us to add manufacturing and value-added processing to our mineral and biomass and other resource wealth. And the IRA sort of intensifies that fundamental problem. We could end up selling lots of nickel to the United States where it gets processed there and turned into high value cathode active material. And we lose out on all that value added in the midstream of the battery supply chain. And we only capture a little bit of mining revenue and royalties as a result. So I think that there's a kind of a structural problem with just ignoring that the IRA or treating the IRA as if it's equal to all these other things that are happening elsewhere in the world as well.
Yeah, and I just say I agree with that. And I just say the obvious flip side of that is it's also a huge opportunity for us because of our location. We're in a position where we can link into the large American market. So while you do see reactions to the IRA from a lot of different corners of the world, and Europe certainly is thinking very intensely, and have already announced some early measures on how they will respond as well. I think Canada is in a particularly acute situation, both from a challenge and a potential opportunity perspective.
Okay, so you've narrowed in to 7 different areas in your paper, and obviously we hear a lot of talk from government and business alike about electric vehicles, about that supply chain, about batteries and critical mineral production. But you've also pinpointed a couple other areas. But why those 7 in particular?
Yeah, I mean, so our starting point for us was looking at the Inflation Reduction Act and looking at where were the key tax incentives that were being provided that could pose this most significant threat to Canada. So we really just went down the line and said, what does each of those incentives mean for Canada? Certainly there are other areas that are going to be important as it relates to our both economic and climate strategies, but that was really why we focused there for the paper.
Yeah, and we could have done offshore wind, we could have done onshore wind as well. And in fact, we probably will do some of those in the broader public report that will be released later this spring. And we also could have looked at different advanced manufacturing tax credits. But those other advanced manufacturing tax credits are focused on the solar and the wind supply chain. And they're really looking to reshore American production there. And Canada doesn't really have a play in those supply chains. So we ignored those tax credits because I don't think it would make sense for Canada to try to become competitive with China, Germany, and the United States as intermediary manufacturers in the wind and solar supply chains, which are very mature. These have been established for 30 years now. It's going to be very difficult for us to break into those global value chains. It's better for us to focus on value chains that are forming today and have a strategic response to break into them as early as possible.
Okay, so yeah, so let me just pick up on that then. You know, when you took us through the 7 areas, it looks like the most problematic and are probably the ones that we talk about the most: hydrogen and battery manufacturing. And so when you look at the policy fixes or the enticements that government could put forward to attract more investment into those areas, I mean, how much is that going to cost? How much is there a way to make that kind of efficient and to eventually get to a point where maybe a subsidy wouldn't be warranted?
Yeah, we're looking at this now. We've kind of crunched the numbers on the battery supply chain specifically. So looking at battery manufacturing and then cathode, anode, as well as nickel and lithium, which are all numbers that we provide in the report. And if you just take a simple kind of gigawatt hour target, so what we have done in some of my work that I did with the Accelerator Alliance and the Battery Metals Association of Canada and the Energy Futures Lab to build a roadmap for critical minerals in Canada, we indexed to the current share of Canada's North American supply chain, which is we produce about 10% of North American cars. And so if you use that same 10% target and say we're going to produce 10% of the metals for the whole battery supply chain, it ends up being the subsidy value. If you match the PTCs, the subsidy value would end up being about $40 billion over the life of the IRA if you wanted to match it. Now, the majority of that is coming just on the batteries. The cathode and the anode and the critical minerals credits are actually not as big as the batteries because we're talking about $4 billion a year for 90 gigawatts for the batteries themselves. So that's an incredible outlay of public money, and it raises questions about when and under what conditions that's justified, that amount of outlay. But I think the value added case for the subsidies on cathode and on select critical minerals to match the PTCs there, I think the value added case is very strong, which is to say that they do justify a public subsidy in those areas. And that would only really be, in our estimation, about $5 or so billion over the course of those credits.
Yeah, maybe just two quick additional comments. I mean, first, of course, cost is something that is that we are concerned about, and we do want to make sure Canada's making smart strategic bets. We're not just advocating to spread money around everywhere. We really were concerned with areas where it felt like it was viable for us to compete from a financial perspective, and that there were outsized economic benefits to bring to Canada in terms of export opportunities, jobs, investment, et cetera. There's also, of course, some areas where we believe we can close the gap through the carbon pricing system, and where we can do that, we should do that. Why wouldn't we do that? It won't cost us anything really if the system is designed properly. But the last comment I would make here is, well, I think it's certainly important that we continue to think about cost and be strategic about where we invest. I think we also have a choice here in Canada between, so far I would kind of say we have been cautious Canada, and our neighbor to the south is ambitious America. And we can I think we can be in a cost minimization, risk minimization mindset, or we can be in a economic opportunity, seizing the moment mindset. And I think it's hard to be in both of those mindsets at once. I think historically we have been more in the former. So the question now for us is, are we going to stay in that cautious mindset, or are we going to shift to an ambitious mindset? And obviously we think the latter is merited here.
Okay, so one last question for me, and then I'll turn to the questions that are coming in through the Q&A. So there's a budget coming out probably in a few weeks, and all indication is that the government is very seized with this exact issue. If you had one or maybe two wishes each to see there, and I'll just, point out that, just reiterate that, as you mentioned earlier, there's an urgency to this, because if you're the first mover, you get the investment, right? So given that urgency, what two things would you see in that budget each? Or let's go for one each, just so we can get to more questions.
Well, mine's easy, so maybe I'll start with that and I'll hand it to Bentley. And I think we're probably pretty aligned anyway on all of these. But for me, the starting point, the foundation for the strategy, and it's not sufficient. We need other things, but a smart strategic starting point would be to announce that the government is going to design a set of off-the-shelf contracts for difference that will be accessible broadly to both existing and new investors in low-carbon industrial technology. I don't think it costs anything if designed properly. And even if all the details aren't ready, I think that signal is needed in the budget.
Yeah, for me, I think that I'll give a kind of a wonky answer, which is that I think it's probably too tight for them to actually announce PTCs, because there's be a bunch of things that they would have to figure out. So instead, what I would settle for, or what I would think would be a really good response from the current position that Canada is in, is something akin to what the EU industrial plan did, which is that they indicated right away, look, this is what the structure of our response is going to be, and we're going to fill in the details later. So what I would like is a structured, high-level response in the budget that says something like, look, we're going to get serious about net zero industrial policy. And what we're going to do is we're going to sit down and work with industry, Indigenous communities, labor organizations, and financial institutions. And we're going to make targets. We're going to set timelines to meet those targets. And we're going to create new institutions to foster strategic collaboration with all parts of society in Canada. And this is actually consistent with a report that BCC just put out last week, which suggests that actually new forms of collaboration between the government and industry are necessary in order to meet the net zero challenge. And from where I sit, and from the work that we've done at the Transition Accelerator on good international practices on industrial policy, that's the key. The key is not designing policy incentives once and then saying we're done. The key is sitting down, developing the forms of collaboration that allow you to solve problems and respond agilely, nimbly, and strategically to events over the course of a long transition. And so it's really, for me, about setting in place a process whereby we can get these things dealt with in a systematic way moving forward, create focus, and really mobilize all of society towards the same goals.
So just to follow up here, and I know I said I'd move to the audience, but I will in a minute, but just to follow up, Bentley, the process you described, yes, absolutely. The Business Council has come out with the same kind of recommendation that the collaboration is desperately needed, and it's in everybody's interest. There's collaboration is actually, there are a lot of common areas that seem to be pretty easy to find. It just takes time. But if we don't have time on our hands, I guess I'm worried that there are major investments right now that are on the bubble that, are either they're thinking, should we expand here? Should we expand there? And they're going for there because we are busy with process.
Yeah, I mean, I completely agree. I would just say that we're already 5 years behind on process. So the European Battery Alliance was launched in 2018. The Department of Energy started to do these critical roadmaps the day that Biden came into office. So we're already behind on process. So we can't delay process any further. But of course, I take your point. And if the government is ambitious, then yes, an ambitious statement today would be that we're going to lay out production tax credits in these areas that we consider high priority for the Canadian economy. These are critical to the future of our country. Let's lay them out. We'll set the levels in the fall economic statement, but we're going to do them. And we're going to do them with an eye to global competitiveness. That would certainly be welcomed by me.
Okay, so I'll turn to some questions, and I'll just say from the outset, some of them are very technical and some of them are very broad, and I will try to, I'll try to mix them up a little bit here. Let's talk about carbon pricing first of all. So, how can you perhaps explain a little bit about how the carbon pricing system that we have in place already, how does that make Canada more competitive? How does that actually serve as an advantage, and how does it actually, if there are more tax credits to come, how do they mix in with that carbon pricing system to make us more competitive?
Yeah, so I think there's two key elements of this. The first is that by sending a signal across the entire economy through carbon pricing, what that policy is doing is it's advantaging low carbon technologies versus higher emission technologies, because those higher emissions technologies are going to have to pay more in carbon pricing than low carbon technologies. If you take hydrogen as an example, traditional hydrogen from fossil fuels is going to face a higher carbon price than hydrogen that is produced with carbon capture or that's produced with renewable energy. So that's the first part of the incentive. But the second part, which is actually a larger share of the incentive, is that for firms who do either convert to cleaner forms of production or who start with newer forms of production, depending on, to Bentley's point, on which jurisdiction you're in, but we'll leave that aside for a second, are going to be able to generate these credits, which are essentially like vouchers or tickets that they can sell to other companies, and those companies will want to buy them because they'd rather not have to pay the carbon price. And so in that way, if you have, say, let's take the hydrogen project that we're describing at the beginning as an example, I mean, that low carbon hydrogen production will be advantaged from the start versus traditional gray hydrogen, and it also will have very significant potentially revenue coming to it from carbon credits.
Okay, thanks. So, turning to public opinion, which, is important to factor in here, because I think, if the government's going to be out there having a whole bunch of this in the budget, the public has to be behind that, right? And it tends to be somewhat difficult because the returns are so long term. And at the same time, so here's the question, some climate groups anyway, are opposed to any kind of subsidy that goes to oil and gas, whether it be through CCUS and any kind of tax credit to switch to clean energy. And they would prefer government funds be, just purely going to clean energy infrastructure or, home retrofits and so forth. How do you respond to that kind of thing?
I mean, I think that the most important thing to consider there is that, we completely understand where that's coming from, and we don't want to advocate that either. But I think it's important that CCUS be understood, not just as a technology to help oil and gas. It's actually critical to lowering the carbon intensity of all kinds of products in the net zero economy. So one of the projects that I talk about a lot is a facility to make sustainable aviation fuel in Texas that uses wood biomass, and it uses carbon capture and storage to make sure that that sustainable aviation fuel has the lowest possible carbon intensity, which makes sure that it will fetch the best price in those fuel markets that we talked about in California. And that their CCS is being used to produce sustainable aviation fuel and lower the cost of that. So it's not the case that CCUS is simply a payout for oil and gas. And I think that there's a lot of ways to use CCUS across the economy that is not going to be used in that particular way. But I would also say that, we live in a big country, and we're a country that is dependent on oil and gas in all kinds of ways. And if we're going to be realistic about a transition framework, and this is what we do at the Transition Accelerator, we have to be able to think about how we're going to build the coalition for a net zero economy. And what that means is building up and providing an off-ramp for the people and the industries that are in the oil and gas industry today. The firms and the people in that industry need to have a place in the net zero future. And one of the ways that we can do that is through CCUS. So it may not be the favorite technology of lots of folks, but it's one that provides a secure basis to build the coalition, broaden the base for transition, and to get us there in a successful way.
Yeah, and I just add, I agree with that. I mean, I think, look, to me, it comes back to the principles of what are we trying to achieve as a country. First of all, we're trying to achieve emissions reductions. And I think we need to be very clear-eyed about the fact that emissions reductions are a good, regardless of where they come from or which sector. But we also have other objectives, and Bentley alluded to this, but there's economic growth, there's affordability, there's energy security, there's national unity objectives. And I think when you put those together, our own view of clean prosperity would be, we shouldn't be, I think we should stick to the principles and look at the data and not talk about certain sectors or certain technologies being in or out.
So how do we make sure that all of this, you just mentioned a whole bunch of other political concerns that have to be taken into account here. How do we make sure that in the end, we are actually, everything's in alignment with 1.5 degrees Celsius in the change of the climate? I mean, embedded in everything in our understanding is net zero is kind of everywhere. It's ubiquitous. But, if you get into each of these credits, how do we know they all add up?
Well, I think there's a couple parts of that, and it's an important and big question. I mean, I think the first thing for me is that if we're going to take our decarbonization objectives seriously, we have to make sure that those investments make good economic sense. And so the credits and some of the other analysis that we've done in this paper is part of doing that, is saying we want to get to a point where doing the right thing is also the smart thing for business. Now, it's not the only part of the approach. Clearly, that's going to be matched with other kinds of policies, regulations, and other policies, but that's a key part of it. And then, of course, we also need to be matching that with credible and transparent modeling that shows where we're going. And then lastly, I would say we should be pretty clear-eyed about the scale of the challenge that's in front of us. Even if we hit the emissions reductions targets for 2030 of a 40% reduction, which I think is going to be quite a challenge, we still will probably exhaust the total carbon budget available to Canada, which is to say the total amount of greenhouse gases that Canada can put out into the atmosphere before we would exceed 1.5 degrees by 2032, by my math. So we are also going to need to get very serious very quickly about negative emissions. We mentioned direct air capture, but there's lots of other technologies coming up behind it in the carbon dioxide removal field that I think we need to pay serious attention to as well.
Okay, so Bentley, maybe you could pick up on that and talk a bit about leadership. So, you made some recommendations here. There are more to come in your next iteration of this paper. And clearly there are a lot of huge decisions that have to be made, but who it's on who, where should we be looking for leadership, and who the onus is on who here?
Well, the easy answer, of course, is to point to the institutions of government that have to make hard decisions right now in the next couple of weeks and lead up to this next budget. And I don't envy their position. I really don't. And Michael and I understand the pressures that they're under, and I think it's very difficult to thread the needle here. To provide an ambitious and bold support for the net zero economy under such competitive pressures is not an easy thing to do. I think that also, though, we have to think about industry and financial institutions stepping up here. In a lot of cases, I think that the business case is there, actually, but the complexity of it and the unfamiliarity of traditional financial institutions and the unfamiliarity of traditional industries with what the technology options are is actually itself providing part of the barrier. And it's part of the reason why collaboration is actually quite important, because what we need in society as a whole is really good flows of information among all the parts of society that need to be on the same page. It's easy to dismiss this as kind of like fluffy talk, but in the hard realities of the economics literature on this, we talk about what's called a network failure, which is that just we don't have information that we need in the places that we need it in government and in industry and in civil society. And so actually increasing collaboration increases those information flows, and it can actually help to drive investment in a particular way. So it's easy to just put all the pressure on the government. I don't envy their position. I do think there's some bold things that need action. And I do think being bold, I agree with Michael, now is the time to be bold. If there was ever a time to be bold and to will be willing to stick one's neck out there for net zero, today is the day, and this is the budget to do it in. But at the same time, I do think that industry has to step up and that society as a whole has to step up, and we have to get serious about how we're going to really solve these problems in a durable and sustainable way.
Okay, so Michael, you talked off the top, just to pick up on this point from Bentley about the decisions having to be durable and sustainable. Talk about you mentioned it off the top. There was a political backdrop here that this could be the last hurrah, I guess, for the pan Canadian. I've forgotten the last word of that.
Framework, probably.
There we go.
Yeah.
And so, you're implying there, I think, that a government change could bring a very different look at how we handle this whole issue of getting to net zero. Is there something that you think, like, how should Canadian government now act to make sure that a system is predictable and sustainable over the long term, so that investors can actually invest with some kind of certainty?
Well, I think the area where there probably is a lot of potential alignment across parties, which could lead to durability, is really thinking about the opportunity in economic terms. I think unlike a decade ago, or certainly any time before that, we are now in a position where it truly is smart business and smart economic strategy to take advantage of some of these opportunities that are going to lead to decarbonization as well. So the more that federal government policy can be thinking, I think, both about decarbonization and economic growth, investment, jobs, and of course affordability too is always key. The more that those policies are going to be sustainable. I think another piece of it is trying to work in collaboration with the provinces, in addition, of course, to Indigenous peoples, the business community, and civil society. But I think if there can be policies that provinces feel bought into, that will lead to more durability of the system as well. And the last piece, maybe an obvious point, but things like these contracts for difference do provide that certainty for business, regardless of what a future government looks like. Because even if on the downside the contract is canceled, they can have the confidence that that the prices that they've been guaranteed in terms of economic value will go forward. In other words, the government will owe them money if the programs are in fact canceled. I certainly hope they're not canceled, but that does provide a form of insurance.
Actually, somebody in the chat just mentioned the word durable, which is a perfect word, I think, to describe what we're looking for here.
Absolutely.
Bentley, we are talking about, this whole conversation is phrased as if the IRA were kind of static. We have this this spending and these measures set out by the United States, but they have so much political upheaval, probably more than we have here. And, we do read about the trouble that they have sometimes in approving projects and regulations getting in the way, which is a conversation we are very familiar with. Are we, how do we deal with that kind of uncertainty? And are we perhaps a little bit too navel gazing in terms of assessing how to deal with uncertainty when it comes to investing for net zero?
Yeah, I think actually that the Inflation Reduction Act is going to be a lot more stable than people might think that it is. I think that if you look at where the early investments are going in the United States, they're actually going predominantly into red states. And so Republican governors completely understand what economic development looks like, and they don't really care whether it's a green technology or not, if it's creating jobs and improving the economic prosperity of their states. And I think we've seen the same thing in Canada. Premier Doug Ford has come around on electric vehicles really fast. And now you're seeing them getting really serious about what a net zero strategy for Ontario looks like, even though that their color is blue. And I think we're going to see the same effects at the federal level as well. I think we're in a completely new space than we were 3 or 4 years ago on that matter. And that's why I think it would really pay to go bold on industrial policy, because I think once you put those things on the table, it becomes very difficult to take them away, right? And that has a double-edged sword to it. So it means you have to be smart about how you're going to deploy it. But it does mean that you're creating, again, this coalition for change. And in the academic literature, this is a key insight of why you want to do green industrial policy. You're creating the economic interests for deeper decarbonization. And we can see this in Canada already with the CVMA, the Canadian Vehicle Manufacturers Association, pushing for bigger EV incentives, right? And that actually, for me, that's not my favorite climate policy. But I can see that it would drive deeper decarbonization. And so what you want is for powerful interests to be locked in and be pushing for policies that would drive deeper decarbonization in your country. That's exactly what the IRA is going to do. And it's part of what is going to create policy certainty here in Canada as well, if we get it right. And actually, just on that point, Alberta is the most interesting and exciting case. TIER in our system, you can opt in. So actually, if you do green hydrogen in Alberta, you can opt into the TIER pricing system. You can't do that actually in Quebec. And so actually Alberta is the place where these kind of incentive issues are actually having the most interesting effects, I think. And so I think that there's a real possibility that we're going to see a real big green coalition grow up in Alberta around both its really excellent wind and solar assets and its relatively open investment environment.
Yeah, I just very quickly add, I was in Edmonton most of last week, and I heard very much the same thing. I think there's a huge opportunity here, and I think folks on all sides of the political divide there are seeing that opportunity. I think it's one of the most hopeful things about the decarbonization story in Canada right now.
Okay, so just we only have a couple of minutes, but I don't want to leave before giving you a chance to talk about what the next stage is. You've positioned this paper as a working paper. You want to do another iteration of that. What are you looking for? And can people, there seem to be many very engaged experts in the audience. Can they help? We need a quick pitch though from you.
Yeah, so absolutely is the short answer. We would love input. Please do reach out. What we're looking to do here is to expand the paper in a number of different ways and perhaps even beyond. But the things that we have top of mind right now are looking at the provincial incentives, because clearly they play a big part. If you look at Alberta, for example, the APIP program, which is a petrochemical incentive program, is a factor for some of these technologies. We also want to look at some sensitivities around some of the assumptions we've made, including the carbon pricing trajectory. And I think we do want to start looking at this on a net present value basis as well, because ultimately that's how investors are going to think about this. So those are just a couple of areas. But I think broadly, we are going to continue to be consumed with this idea of how can Canada make sure that we have an economically competitive offering to attract what could be really high potential economic opportunities for Canada.
Okay, Bentley, did you want to add anything there?
Yeah, sure. I would just say that I think that, yeah, especially for technical experts and folks that are willing to pitch in on this mission, I think it's really important for technical folks and scientific folks to try to understand deeper what's happening in climate policy today. We're in the middle of a revolution, and an industrial policy revolution happening at the global level is something that is really important that we get it right here in Canada. And so our website over at the Transition Accelerator is full of resources. I'm going to drop a new report that we're just putting out today on how to do industrial policy. And I think you'll see there's lots of opportunities for folks to get involved. Really organizing within the sectors. We've had the pleasure of working with folks in hydrogen and sustainable aviation fuel and in battery metals, working with the firms, working with Indigenous communities, working with other parts of society. We can all get involved and we really welcome your expertise in the policy conversations that we're having.
Okay, thank you so much. We're basically done with our time here. But I think if I could just summarize very quickly, I think your messages are like beyond the technical measurements, that there is a huge amount of collaboration ongoing, but we need to ramp that up in a big way. There's a call here to be ambitious and bold, but also to keep plugging away, because this is not just something that's going to be solved in the space of a couple of months over some meetings and the next budget. And also that you're inviting all the good ideas, because that's just the beginning of the collaboration. So thank you so much, and I hope everybody.
Thank you, Heather.
Great afternoon.
Thank you very much. Thanks for your time. Thanks, everybody.